Hello everyone and welcome back. Well, I certainly hope you were watching our live session yesterday because we did certainly get it right as a community in terms of that key demand support level breaching through and moving straight back up to the resistance. We're now in what we call a small coiling market, which we'll take a look at on the S&P 500 a little later in today's video. But I want to discuss not only the key levels moving forward, such as this massive trend line, but also what's happening underneath the hood in the markets right now. Every single news agency and everyone on the street have two words in their mind: inflation and recession. But actually the word that we should be discussing is destruction, because that's really what's happening. And we have some key charts and information to show you in today's video. Stay tuned. This will be a good one. See you soon. Well, welcome back everybody to the show where we talk about stocks, commodities, and cryptos daily. If you like any of those markets, remember to subscribe and of course, smash the like button if you find value in today's video. Today's video is sponsored by Tiger Brokers, and we've got more information about some of the special offers that they have for you as a community a little bit later, and some of the awesome features that the broker offers compared to others. So some great comparisons to be shown. Let's discuss by talking about oil prices and US inflation rates. Well, straight away, we would know by now, or most of us would know by now, if you ever see oil spikes, it's never a good sign for economies. It's led most crashes, that is most recessions in markets. Now, of course, this is being twofold by usually we have oil prices going up and at the same time, inflation going up. They actually are correlated together. So in a few charts that we'll look at in today's video, you're going to notice that all of a sudden oil prices are crashing. And at the same time, we don't necessarily have the new numbers on inflation, but I think the market's telling us that it's dropping like a rock as well to a degree. It might not look like it around us, but we have some charts that are pretty compelling on that. This means the market is moving on to the next progressive step of what people are worried about. And it also changes the game for investments over the next couple of months. In fact, it could be one of the times where I'm talking to bond advisors out there, and some of them are saying maybe bonds are actually going to get close to beating equities. Now, as you'll know, based on this chart here, that's incredibly rare. Basically, equities always cane bonds, and they have done so for a very long time. But there are times sometimes where it becomes less probable that equities will actually beat bonds. And you'll notice that as of this date of recording, it looks like that is one of the lowest on record. So basically bonds are starting to look a little bit better in what we have as a destructive economy right now, with demand dropping like a rock, with fear rising and everything else. So averages are starting to look a lot worse for equities versus bonds and those portfolios moving forward. What are some of the reasons that this is happening? Well, the first one is of course midterm election years. We haven't even started talking about that in the US, but of course it already usually leads to a very bad back half of the year for 2022. And you'll notice in the previous stats, when we've had bad first halves, that is a bad down first half, the second half returns have been all over the place. On average, they have kind of got some gain through them, but what they have been is one thing: incredibly volatile. So we have to expect the unexpected over the next couple of months. And because we're seeing so much big movements in the stocks at the moment, we may actually hit an S&P 500, 3,000, 3,200, or even lower before we actually begin rallying to the degree of a real recovery coming back in. A lot of that's got to do with dynamics that we'll discuss in today's video a little bit later when we look at the charts. Some surveys are coming in from the general retail crowd out there. And as you'll see here, we have here a pretty high bearish number still. Not as highly bearish as it was for the previous weeks. Now, usually when you see an incredibly bearish number from the retail community, it could mean a rally, guys. Let's just say that. The anti of what most people think tends to be the best kind of concept. But we're at 46.7% bear, obviously elevated from the standard 30% bear kind of pessimism in the markets. But if this starts to jump up, and let's say we get a survey report at the end of this week that's showing something like a 30% or a 42%, we need to watch out, because there are certain things happening underneath the hood in these markets that are a little bit scary. The biggest one comes from the previous video we did, where we talked about asset managers purchasing at the lowest rate they've done so in many, many years. So they're incredibly negative overall. And of course, our arch nemesis, the leveraged hedge fund traders, stacking shorts as this recovery comes through. So we've come up a little bit off the base now. We're trading about, 4%, 5% off the base in some of the market indices. This is good in some ways, but as it's going up, we're seeing Wall Street, the composite man, whoever you want to call them, basically the big players out there, adding to their shorts. And this means that whatever rallies we're getting here, at this stage, we cannot believe they're real. And that's a very important thing. If the big players are not coming with us, it could be a false rally. So make sure you subscribe to the channel because we will be following through on this and continuing to discuss it over the next coming weeks. I believe it's going to be one of the key characteristics of recognizing a change in these markets moving forward over the next 6 to 12 months. And look, I'm positive on in 12 months future. And we'll discuss that soon as well because there's so much to talk about today. Here's a bit of a scope for the month of July in terms of the positive statistical days and down days. We're coming into some positive days. Theoretically, Dow 1.4% on average, up 16, down 5, ranked number 4 for the month here. So very strong monthly date, technically the 6th. Will it play out that way? Hey, I don't just use stats. Obviously, you want to bring the technical analysis along with it. But you'll notice here some decent mid performance through the start of the month. And then often, notice those little bear symbols. There's a few bearish kind of things that lurk at the back end of July. And that's, of course, when we'll start to see the big earnings results. Remember, earnings are starting to come out very soon as well. Let's move over to what happened in the previous session. Now, this is for the close of the 5th of July 2022. And you'll notice the Nasdaq was out in front. Why was the Nasdaq performing best? Most likely because interest or yields were coming down. So the US 10-year, the US 2-year, all of these different yields were going down. High beta growth was performing a little bit better. The S&P 500 opened up down, bottomed off very nicely at an exact level that we were discussing in the previous live session. I'd certainly suggest going back and having a look at that live session if you're interested. We pretty much nailed it, I guess. You don't always nail things. You never want to, brag about those type of things. But one thing that was good about it is we used common sense. We used a structural base. We understood the structure. So it's a really good video for you to go watch. You can check it out on our last live stream. Hopefully a few of you were building your systems around that kind of thing and recognizing it, and you got that gap fill. It's one of those higher statistical chance kind of days around those levels. Once you are patient and you react, don't predict. That's the big thing. You react to the market finding the base, then you get into it. XLC doing very well, XLY doing very well, IBB, biotech, one of our favorite sectors at the moment. We've obviously been talking about that a lot. A huge amount of stuff going on in all of these kind of charts, which is really good. It's showing us a little bit of growth pickup. But again, I'm very skeptical on any of these rallies long term. And it's mostly because I haven't seen any signs yet that the big funds are coming through with us. It just seems to be all these rallies seem to be more of a false kind of rally than anything else, what they call the bull trap. So let's talk a little bit about Tiger Brokers and some of the key features that they offer traders and investors out there that I think are defining factors of what makes them a really good brokerage firm. One of the big things is, of course, free in-depth data, and you can get that with as little deposit funding as 1 cent. The other thing is that they also have real-time data for both the US and AU markets. You'll notice this is a big defining thing, especially for the Australian audience out there, which is free in-depth quotes for both US stocks and ASX stocks, which is totally different from a lot of the other providers available. And as you would know, I love level 2 data. I love having access to more information and especially understanding where the flow is. So let's take a look at the platform. And one of the things I love about the platform just straight away, when you have the charts up, knowing where the dividends are. For any Australian investor out there or anyone really in the world, knowing where the div is very important as a trader and as an investor, along with the earnings and when they're coming out. But I also particularly like over here on the right-hand side, the level 2 data. And you'll notice there's a few things that are excellent for traders, and you need level 2 data. Whatever platform you're using, it's really essential you get this. To be able to understand that 392 for today's trading so far has been the big level, that gives you a bit of a demand zone where you can say, well, do I see support? Do I see demand around this level? If you do, guess what? That's where a lot of trades have happened. So obviously it probably holds a bunch of orders, yeah? Very important zone. Level 2 data also helps us to get a bit of an understanding on where all the orders are currently sitting in the markets, the kind of buy walls and the sell walls. And it also helps you when you're setting take profits and entries. A good example of this would be, let's say 390 was a level that you wanted to buy at, but there was like 40,000 units there and there was only 500 units at 391. Well, guess what I'd be doing? I'd be buying at $3.91 so that I don't have to go into the queue. Things like this can really help change the game in trading and investing. And if you haven't considered it, definitely consider Tiger Brokers. Link in the description down below. Whole bunch of countries available out there, but there is a special promotion that runs till the 12th of July for Australians where you get a free Apple stock as well when you open an account and fund it with a certain amount. So check out the special offers. There's a bunch of other free stocks as well, GoPro as well, and a whole bunch of other things for the Australian audience, and other countries get some bonuses too. All right, well, I want to get back into the charts and let's discuss here demand destruction. This is the chart that you should be watching. We've discussed it several times before. It's Dr. Copper. Now, for anyone that doesn't know, copper is one of the most used metals in the world for industrial builds and, of course, anything to do with infrastructure. And right now, it's coming off a cliff. Now, if you're familiar with things like Wyckoff patterns, you would know that up here was a massive distribution. We spoke about it on the channel, and you better believe we've been correct on this one because the market is absolutely tanking off this level. It's as we kind of suspected, and unfortunately, because of this massive tanking, it shows us a real slowdown in the economies around the world. It kind of reminds me of what happened over here in 2014 to 2016. That was incredibly brutal for actually anything to do with energy, anything to do with mining, metals, and it kind of shows us that inflation is actually not the concern of the markets, nor is it concern of anyone at the moment. It's destruction of the demand and destruction of the whole monetary system. That's starting to flow through into some other things as well, including oil. Hey, look, anything can happen, but it's starting to really destruct this chart. And you'll know if you've been following us for a few months, I've been pretty negative on oil, and the reason actually has to do with this particular area over here. But there's a whole bunch of other stuff that's going on. And unfortunately, I could see oil, or fortunately maybe, I could see oil dropping off. Now, a lot of you will say, well, isn't that awesome, Tom? Come on, man. That's awesome. I'm going to get cheaper fuel. It's good in that aspect, but it's bad because it also means that there's a huge amount of destruction to the economies of the world occurring. And you've got to consider both of those things. Often, you know, anything can spike, such as oil. Of course, if we see something going on with Russia, they don't provide the oil or whatever else could happen, then of course this will spike up. And it is a dangerous trade, but at the moment we are seeing destruction of the metals, destruction of the commodities, and that's being felt across the board in price. And it's why the Nasdaq was doing quite a lot better. Now, we had a bit of a blowout in the last session of the DXY. This is the US dollar. Not really a great sign for the stock markets either. More money going into cash, it often leads from this kind of market in terms of if we continue to see the DXY going up, it doesn't bode well for the SP 500 and other markets around the world. But the other problem that we've got here is where does it stop now? And we'll take a look at the DXY soon. But yeah, this correlation is no joke. Money flowing out of Europe at an incredibly fast rate. We've seen dumping in the US, in the European stock markets, and of course, money flowing back into the US stock markets a little bit. These types of things are a little worrying when you start to look at them on the charts. Here's another way of seeing the demand destruction in place. Basically, the US 10-year has gone from 3.5% expectation all the way down to 2.833. And if we load up the 2-year as well, you'll notice that they are currently inverted because this is 2.84. So that means the US 2-year and 10-year are currently actually backwards. And this is showing you pretty much the signs of recessions coming. Now, I don't really care about the recession word because it's just a word. We're already seeing massive destruction, and that's a big thing. Recession just means, yeah, we're in a recession. But what's the damage that's happening? Recession is a word. I like to look at the averages of where markets go, and I will bring that on the chart a little bit later. What I'm seeing right now from the bond market is this. The Fed will raise actually above this number. So they'll get above 2.84. It's expected at the time of this recording, they'll get to about 3.4%. And then in 2023, at some point, usually around the middle of the year, maybe even earlier, they'll have to start aggressively cutting. And they'll end up cutting in 2024 at this stage to 2.6% or even less, maybe even 2.4%. What this is showing us is that they're going to do so much demand damage because this is what the Fed controls, that it's going to end up leading into a forced cut, which most likely, if property can survive this, will actually end up leading into a bit of a buy in property, which could go ridiculous. So this could actually cause 2 US recessions. So we might even go into a US recession, let's say here, and then we'll cut and then later on we'll go into another US recession, similar to what happened with Volcker in the 1970s, 80s, that type of period. So it's very important to note that this is an incredibly tough time in markets to make very long-term predictions, because that yield curve is actually going to go down, and we're now starting to see inversion almost everywhere, which is a big problem in these markets. Let's take a look at the US dollar. As you can see, it broke through pretty heavily here on the 4 hour and it's held up. Now, if this just gets destroyed back down, what could this become as a schematic? Well, it could become, here's your buyer's climax, here's your UT, and of course, then we look towards, of course, shorting the US dollar. That's a chess kind of play. We're looking into the future and we're saying, is this possible? The answer is yeah, it's possible, but of course we don't know that yet. At the time of this recording, I can tell you 86% of retail traders out there are trying to go against this trend. So they're trying to go against the dollar index going up 86%. And that's been pretty consistent since around here, that it's been a very high percentage. It's funny how everyone tries to go against the trend. I'm not saying go against the trend. I don't even know if it's going to go up that much more. I mean, if you look at it on something like a weekly, you would say, well, the trend is currently quite bullish and we could easily move to like a 108, even 109 kind of 50 zone plus before we come back down. But it's something that I'm waiting and seeing. And remember, even if you think, oh, well, I could be in a trade, there's an opportunity there, you don't have to take it. What it does tell us, though, is that money is flying into dollars, that is US dollars. And it's the only perceived hedge right now in the economies out there in the world. And that's funny because you would think gold's going to do better. Well, no, it doesn't. Gold actually fell through the demand level that we've discussed for a long time in the last session. We never got that run through. It just went plonk straight in. And of course, now it's at a second demand zone. But after this, there's really not much left for gold. And I think gold is an absolute wait and see. We've got no money flow coming in from the big guys. In fact, they've been trying to short gold recently. Everyone's trying to be bullish on gold. And while I am bullish on it into the end of July into August because of certain other factors that are there, haven't seen the signals yet. And that's the problem. We're just not seeing enough strength. Over here, things look good. Of course, a lot of those orders will have been taken out by now, rightfully. You shouldn't be holding all the way down. And now we're looking for, do we see some recovery around this second demand zone? At this stage, at the time of recording, we don't see anything. Let's move over to Tesla. It's in the middle, guys. We have here a bunch of little order kind of levels, dojis, wicks, those kind of things. So we're stuck in the middle. We have our strong demand zone. We have our strong supply zone or resistance. And everything in between here is a bit of a guess. The market does look kind of bullish, so we'll talk about that soon. And if you do see the market breaking out, let's say you see the Nasdaq and S&P 500 going bullish, maybe Tesla is your jam and you like that stock, expect it to do a better percentage usually than the S&P 500 and Nasdaq as a whole. Let's take a look at the Nasdaq now. So the Nasdaq has been recovering, and you'll notice here, it's come back to the trend line. So this is the trend line that last time it sold off of. So very important next 24 hours here coming into the meeting minutes for the FOMC, because this is basically the level that if we breach, then maybe we've got a little bit of a run. We finally fill this gap zone over here on the left. Maybe we get back to this kind of 12,400 level and we see some nice strength coming back into the US market. The dollar index doesn't point that way, neither does copper, neither does anything else. But of course, I'm not saying this rally is real at this stage. I have no reason to say it's real other than it's most likely a bull trap at this point, whatever does happen. You've got to be nimble and fast, which is consistent with what we always say. When the VIX, that is the volatility index, is above 25 plus, I like to be very fast in markets. And of course, that's where day traders and scalpers and everyone comes out to play. Let's move over to the S&P 500. Here we have the low that we got in the previous session. We actually gapped down. You'll notice here, here's the open. Obviously, was much lower than the previous close. We got into our 3740, 3750 area. We saw some nice structural base, which I'll show you in just a few moments. And then we ramped straight back up, closing, funnily enough, or annoyingly enough, below this big break. So it's basically, this is a coiled market. In the next session, we want to see powerhouse. That is, we want it to break through and hold the position. If it breaks through early and then starts to reverse straight away, we've seen that one before. Let's think of some examples that we've seen. I think I'll use this one over here. That was a classic one. We buy through, big giant shooting star and it's all over. So be very careful about this breakout. We want to see it to sustain. Ideally, we come back in the next recording for these videos. We find a nice green candle, and then we can move up to the trend line. And of course, at the same time, you'd expect the Nasdaq to be breaking through at the same time. Here's a nice trend line that we've got here, S&P 500. I'd love to see it do this, breach, move that kind of gap through, and then possibly the bears to come back in all over 4,000. It's going to be consistent as well with what we're seeing in the options charts. Let's move over to the futures market. This is why you can't trust futures 100%. Look at the little breakout it already did. I don't like to use futures for the breakout coming off a long weekend. Of course, it was a long weekend in the US, July 4th, and this means that this was mostly a false move. It certainly was, and it came back down to our strong demand zone. But when we start breaking it down, this is where we left the stream in the previous session. I haven't, adulted any of these. I've just kind of left them there so you guys can see it. So the big zone that we left was this one here, 37.63.64. And basically I wanted it to breach that level, which it did so a little bit later on in the market. We can see here the switch, we can see the breach. The breach was fantastic. The algorithms come back, or the market comes back, swings in, and we get that movement through. We hold the 37.40. It was actually a pretty good trade. It's a nice structural base, and it's the type of thing that you do want to be looking for. A lot of day traders will have taken their profits off at this point. I totally don't blame them. Sometimes people scale in and they leave a portion on, which I think is very relevant as well. But what a great level. Congrats to anyone that was looking at that, and of course, that had the patience to react and not predict. Tick, 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 tick. Well done, guys. Hopefully a few of you had some success there. Obviously, it's up to you to make your own decisions and find your own things, but it was just an interesting technical structural base. Let's move over now to what's going on this week in terms of options. So we'll quickly just refresh here the 8th, and you'll notice we still have a lot of calls sitting at 412. I don't know what they're doing, but I doubt the market will be able to get above those very easily. And there's a bunch sitting at around 370 as well in terms of puts. More puts open than calls at this stage in terms of just a larger value of them. This is for the Friday expiration, and max pain sitting at 382, which is pretty consistent with where the market's currently at. So at this stage, the upside is possible. However, it could be capped by the amount of calls out there. If you haven't already, come and follow us at FX Evolution on Twitter, or join our Discord community down below. We've got a free Discord community, almost 10,000 members in there. And of course, we have a private community as well. If you're interested in more of our free streams, you can join free 7-day trial down below. Let's have a look at the news for the market week ahead. We've got here FOMC meeting minutes, the JOLTS job openings Wednesday. This is happening at 2 p.m. New York time. Then we've got ADP non-farm employment change, 8:15 a.m. on Thursday. And then on Friday, we have a big one. That is the non-farm payroll itself, the unemployment rate numbers. This is going to be a big blockbuster one. Expect it to be kind of, I think, pretty crappy, but I think the market probably already expects that. This is the number that the market's going to care about and the news is going to care about for the next couple of months. And it's going to be the one that the Fed is watching the most, because if it starts turning bad, then of course the Fed will try to do what the market's already saying, which is they're going to try to cut the rate after raising the rate. As always, if you haven't already done it, check out the link in the description down below, or the pinned message. There is some excellent offers from Tiger Brokers. And if you're interested in level 1, level 2 data and all the other great bonus features that they offer, of course, go and check it out down below. Thanks so much for watching. Remember to subscribe, smash that like button. We'll see you in the next one. Bye for now.